to talk about the markets, Kathryn Rooney Vera. She's the head of research and chief market strategist at Baltic Capital Markets. Kathryn, it's good to see you this morning. So the S&P 500 within striking distance of an all-time high with these better than expected earnings. We might get there today. What is driving the markets?
Well, it's stimulus. It's both monetary and fiscal stimulus that's driving the markets. It's the reason we're scratching at record highs in the midst of massive uncertainties and an economy that's showing signs of recovery, but certainly not out of the woods. So I would say that the market is in for a nasty surprise if it doesn't get another fiscal stimulus package. Is completely banking on that. And I don't think the Fed is going to disappoint, Kristen, with regard to the asset purchases that it's going to continue to make.
At what point, Kathryn, does the market get impatient with Congress, the fact that we still don't have yet another stimulus package?
Gosh, it's hard to know because we haven't been disappointed yet. I mean, we already have a $2.7 trillion package that hasn't even really been executed to its entirety. So should the market be impatient, and will it be impatient? When will it be? It's really hard to tell you. But what I can say is that unemployment benefits will and must be extended because they're the main driver of the increase in consumption. Ask oneself, Kristen, what are the drivers of consumption? I would argue that they're twofold. One is government benefits. We saw from latest official data that 30% of personal income is now tied to government benefits. And the other one is pent-up demand. So if you're going to continue this recovery in consumption, given that so much of it is attached to government stimuli, then one can expect that to occur. And I would be surprised if they didn't come to some agreement with regard to an additional fiscal stimulus package.
How much can that stimulus that we already got injected into the market, Kathryn, be attributed to the gains that we see in Walmart, Home Depot, and Kohl's in their results out this morning?
That's a good point, and it's very difficult to measure and parse out what comes from fiscal stimuli and what doesn't. But in an economy that's mainly consumption driven, and given that 30% of personal income now comes from government benefits, when pre-crisis it was 5-10%, then one can say that a good amount of that is due to fiscal stimuli. What we can also say is that the jump in consumer sentiment, which can be attached, at least in some part, to the 40 or 45% run up in the stock market, we should attribute a large majority of that to what the Federal Reserve is doing, which is taking their balance sheet from $4.5 trillion at the end of last year to about $8 trillion now, and likely to $12 trillion by the end of this year. So I don't think we can underestimate the potency and the importance of stimuli, both fiscal and monetary, on where we at right now, both in the market and economic cycle.
So it's interesting, Kathryn, you were mentioning earlier that those extra unemployment benefits, the additional $600 that people had been receiving on a weekly basis, that is a direct hit to this economy. And some of the numbers that I saw was that for every month that goes by that consumers don't have that initial several $100s in unemployment benefits, it takes about a 0.5% off of GDP. Does that sound about right to you?
Well, it could be. I haven't seen those numbers, Kristen, but I think it is very relevant. And I'll just give you some additional numbers. So about 2/3, and this is also official data, comes from 2/3 of the people that have been working previous to getting laid off are now making more money with the top off, with of course the unemployment benefits plus the top off, which we can expect to decrease a bit. But with that top up, they're making more money than they were employed. So I think, that's good for consumption. But on the other side, we really have to factor in that impedes the willingness or the urgency to return to the job that they were making less than they are currently on the benefits.
Kathryn, I don't know how closely you've been following Tesla, but the stock up another 11% yesterday, up close to 3% pre-market. It is set to open at an all-time high, and there is this question as to whether or not it will actually be added to the S&P 500 by the end of the year. It has meted the threshold in terms of 4 quarters profitability, but because there is so much momentum behind this stock and the bears are still very loud out there, what sort of volatility could that infuse into the S&P 500?
That's a great question, and the S&P 500 has been impressive in the sense that since 2017, if you look at its performance has been mainly driven by the five most famous tech stocks. So if you add another kind of luxury tech name to the fold, then it's even more heavily weighted to that area. So what I would say is that what we're currently seeing is a broadening out of the performance in the S&P 500, and I welcome that. I think that if it's entirely driven by one sector or five names, as has historically been the case in recent years, then we are incredibly vulnerable. We're vulnerable to higher regulations, antitrust issues on these names. We're vulnerable to higher taxes, all of which I think is inevitable if we get a new administration in November. So I think at the current juncture, we're vulnerable, and we need to see a momentum behind the broadening out of the performance of the S&P 500.
So it's interesting. We've already seen these tensions between the U.S. and China, Kathryn, ramp up, and the expectation that we're hearing is that it's only going to get louder and more contentious leading into the election because it is one of President Trump's pillars that he really tries to be tough on for his campaign. But it really hasn't had much of an effect in the market. I mean, do you think that there will be some sort of inflection point where the tough talk does get to a point that it does have a negative impact on stocks?
I don't think so. I think this is just political noise, and I wouldn't be surprised if it comes from both sides of the aisle, given how politically expedient it is to beat up on China, especially at this juncture where we are in the global economy and with what has precipitated this crisis. What I will say is that I think that gold is a chief beneficiary of this uncertainty, and we've seen gold do nothing but really rise. And I expect that gold will continue to rise because we have low interest rate policy, expansionary monetary and fiscal policy, uncertainties, as you mentioned, Kristen, Chinese, but others as well. And really the prospect of inflation, given the inordinate amount of stimuli that we have already incurred up to this point, which really, if you look at the numbers, makes the response to Lehman Brothers look like child's play. So I think people really underestimate the magnitude of the numbers that we're talking about right now. The fiscal deficit has been quadrupled, and the Federal Reserve balance sheet has already almost been doubled. So these are impressive numbers, and this is the reason why I'm recommending, Kristen, that our clients, if you're going to stay invested in the markets, hedge yourself, protect your positions. I don't think gold is a bad buy. I don't think raising a bit of cash is a bad buy. If you're going to buy the markets, do it in a married put option, which when volatility collapses, which it has and is low right now, then the put option becomes very cheap. So you can buy the market, but protect yourself for a considerable period of time.
All right, Kathryn Rooney Vera, she's the head of research and chief market strategist at Baltic Capital Markets. Kathryn, thanks